Today, the Federal Reserve held interest rates right where they are, 3.5 to 3.75%, fourth time in a row, and for your wallet, that one decision changes everything. Translation, cheap loans are not coming back this year. Your mortgage stays stuck, your credit card keeps biting. But hold on, there's a flip side most people miss. Plus, 2 more stories landed this week that hit you right in the bank statement. Your health insurance just jumped 26%, and next year's Social Security raise, it's got a catch. Welcome to the channel where we take the week's biggest money news and explain, in plain kitchen table English, exactly how it lands on your wallet, whether you're middle class or already retired. So grab yourself something good to drink, get comfortable, and hit subscribe because we drop these breakdowns Monday, Wednesday, and Friday. Let's get into it. Quick heads up before we dig in. Everything in this video is for education only. It is not financial, tax, insurance, or medical advice. These are the numbers as they stand today, June 17th, and some of them are still moving. Before you make any move with your money, your coverage, or your retirement, check the official sources and talk to a licensed pro about your own situation. We just connect the dots. You make the call. Story 1. The Federal Reserve. Picture the thermostat on your house, except this one controls the temperature of money itself. Today, for the 4th meeting straight, they refused to touch the dial. They left the rate sitting at 3.5 to 3.75%. And this was a big day. It was the very first meeting run by the new Fed chairman, Kevin Warsh. Everybody watched to see if he'd blink. He didn't. Now here's the part that matters at the kitchen table. When the Fed keeps rates high, borrowing stays expensive across the board. The 30-year mortgage is parked around 6.5%. Refinancing into something cheaper, not happening right now. And if you're shopping for a house, that high rate quietly adds hundreds to every monthly payment. And your credit card is the real heartbreaker. Average rate on new cards about 22%. That's the most expensive money in your whole life, and high Fed rates keep it pinned right there. A car loan runs near 7% on average. So why won't they just cut rates and give everybody a break? One word: prices. Inflation just jumped to 4.2% in May, the hottest reading in 3 years. Cut rates now, and you throw gasoline on that fire. So that's the squeeze on one side of the ledger. But every rate decision has 2 sides, and the side nobody talks about is where things actually get interesting for you. Let me show you. Here's the flip side I promised you. If you've got money sitting in savings, high rates are actually working for you. The best online savings accounts are still paying around 4.5%. Short-term certificates of deposit, right around 4.5% too. After years of banks paying you basically nothing, that's real interest landing on your cushion every month. And seniors, this one's for you. Inflation at 4.2% almost eats that whole 4.5% right back up, so your savings earn, and the grocery store takes it away. You're running just to stand still. Now, there's something called the dot plot, basically a chart where Fed officials guess where rates go next. Back in March, it hinted at one rate cut this year. Today, the expectation is they wipe that cut off the board entirely. I want to be careful here because the full June projections were still landing as we recorded. So treat that erased rate cut as the expectation, not a done deal. But if it holds, the message is blunt. Expensive money is staying with us longer than anyone hoped. What to watch? The Fed's official statement, and that dot plot dropped this afternoon on the Fed's own website. Check whether they really erased the cut, and listen to Warsh's tone. Not a signal to buy or sell anything, just a map of how long loans stay pricey and savings stay sweet. Story 2, and this one hits the middle-class square in the chest. Your Affordable Care Act health insurance. The price didn't creep up, it exploded. The Marketplace, that's the government's online store for health plans, healthcare.gov. It's for folks who don't get insurance through a job. Freelancers, the self-employed, small business owners, early retirees who walked away before 65. About 22 million people lean on this, and almost all of them got some government help. If that's you, listen close. Here's the mechanics in plain English. For years, the government quietly chipped in to cover part of your monthly premium. That help was called the enhanced tax credit. On the last day of December, that extra help expired, gone. So picture it, your plan costs $1,000 a month. Last year you paid $74 and the government covered the rest. This year, that same plan, you're paying $158 and up because the help shrank. On top of that, the insurance companies themselves raised prices an average of 26% for 2026. Put it together, and for people getting that help, the out-of-pocket payment more than doubled, up 114%. In real dollars, the average subsidized payment went from $888 a year to $1,904. That's $1,016. straight out of your pocket for the exact same coverage you had last year. And look, don't just take my word for any of this. Go pull up your own renewal notice and put the new number next to last year's. That gap is real, and it's sitting on your kitchen table right now. And there's a nasty trap here called the subsidy cliff. Earn $1 over the income line, and you don't lose a little help. You lose all of it at once and pay the full jacked up price. Middle-class families sitting just above that line get hit the hardest. Seniors, this matters to you too, specifically if you're between 50 and 64 and not yet on Medicare. By law, these plans can charge older folks up to 3 times what they charge a young person. So early retirees living off savings are the most exposed group of all. One honest correction, because we don't fudge numbers here. This is the story of the plan, year already underway, 2026, not some future forecast. The bill is on your table right now. What to watch? Open enrollment for next year usually opens November 1st. Don't sleep through that window. Keep an eye on whether Congress brings that help back. And go to the subsidy calculator on healthcare.gov and rerun your own number for your real income. Story 3. This one's mostly for the retirees, and the picture looks pretty until you read the fine print. Your 2027 Social Security raise just got bumped up to 3.8%. Now, 3.8% on the average check works out to about $77 more a month, taking the typical check from a little over $2,026 to about $2,103. Sounds like a celebration, right? A real raise after a couple of thin years. Hold that thought, because before that money ever reaches your pocket, the government reaches back in with the other hand. Medicare Part B, that's the doctor visit part of Medicare, just climbed to $202.90 a month. First time in history it's crossed $200. For most retirees, that Part B premium gets pulled straight out of your Social Security check automatically before you see a dime. So from that $77 raise, about $18 vanishes instantly into the health premium. So watch what happens to that raise on its way to your pocket. It starts out looking generous, and then, piece by piece, the system quietly trims it down before it ever reaches you. Here's the math. What's left in your hand? Around $59, not $77. It's like somebody hands you a $100 bill, then reaches into your pocket for a $20 on the way out the door, and the deductible went up too, to $283. And here's the kicker. Even that $59 gets chewed up at the store. The inflation gauge for retirees jumped 4.4%. Groceries, rent, prescriptions all climbing faster than the raise. So the check is bigger, but life isn't easier. And one straight shooter note that 3.8% is still a forecast from a seniors advocacy group, not the final number. The official figure comes from Social Security in mid-October. It could drift up or down before then. What to watch? Mark mid-October on your calendar. That's when Social Security announces the real official raise. Until then, 3.8 is the best estimate, not a promise. That's an observation, not advice. So that's what hit your wallet this week. The Fed kept money expensive, tough on borrowers, decent on savers, your health premium more than doubled, and next year's pension raise is real, but smaller than the headline once Medicare takes its cut. If this helped you make sense of the noise, do me one favor, hit subscribe and drop a comment with which story hit you hardest. We run a fresh breakdown every Monday, Wednesday, and Friday, and the topics you ask for in the comments are the ones I dig into next. And remember the rule of the house, none of this is financial advice. It's the map, you drive the car. Check the official sources. Talk to a licensed pro about your own life. The headlines move fast. We'll keep doing the math so you don't have to. See you Wednesday.